At 9:30 on the morning of the 1st of August, 2012, the opening bell rang on the New York Stock Exchange, and a company that had been in business for 17 years began to destroy itself at a rate of roughly $10 million a minute. It took 45 minutes. By the time the trading was stopped, Knight Capital Group had lost $440 million, more than its entire profit for the previous 2 years, and more than the company was worth. Within a week, it had surrendered 3/4 of its equity to a rescue consortium. Within 5 months, the firm no longer existed. Nobody stole anything. There was no fraud, no rogue trader, no bad bet on the direction of a market. Not one person at Knight Capital made a decision that morning that lost money. There was no market event either. The 1st of August 2012 was an unremarkable Wednesday. The indices barely moved, no central bank spoke, no company of consequence reported. The conditions that destroyed Knight Capital were entirely internal, and they had been in place, unnoticed and harmless, for 7 years. What happened was that a piece of software did exactly what it had been written to do 9 years earlier. In a part of the system everyone had forgotten was still there. This is a story about dead code, and it is the closest thing modern finance has to a pure laboratory experiment. Every other disaster in this series involves human judgment, greed, optimism, self-deception, the ordinary machinery of people talking themselves into things. Strip all of that out and you can still lose $500 million before lunch, because the machinery that moves money is now written in software, and software does not know what year it is. Start with what Knight Capital actually was, because it is not a household name and it should be. Knight was a market maker. Specifically, it was the largest retail market maker in the United States. If you bought 100 shares of Apple in 2012 through an ordinary brokerage account, there is a very good chance that the shares you received came from Knight, and that the transaction never touched a stock exchange at all. That business is worth understanding because it explains the scale of what followed. When a small investor places an order, the broker does not usually send it to an exchange. It sells the order flow to a wholesale market maker, who fills it directly from their own inventory. The market maker quotes a price to buy and a price to sell, and the gap between the two, the spread, is the profit. On any single trade, it is a fraction of a cent. Across 100 million trades a day, it is a business. Knight handled something in the region of 10% of all U.S. equity trading volume, and a substantially higher share of retail volume. On a normal day, it traded around $20 billion worth of stock. It was, in the most literal sense, part of the plumbing, invisible, unglamorous, and load-bearing. Now the specific event that set the timer, because none of this happens without a deadline. In 2012, the New York Stock Exchange launched something called the Retail Liquidity Program. The idea was straightforward. The NYSE had been losing retail order flow to wholesalers exactly like Knight, and it wanted some of it back. The program allowed exchange members to offer retail investors a small price improvement, a fraction of a cent better than the publicly quoted price, in order to attract those orders onto the exchange. The Securities and Exchange Commission approved it for launch on the 1st of August, 2012. For firms like Knight, participation was not really optional. If the NYSE was going to offer retail price improvement, a wholesaler that could not interact with that program would be at a disadvantage. So Knight had to build software to handle the new order type, and it had roughly a month to do it. That is the whole setup. A regulatory change, a fixed go-live date, a compressed development window, and a firm that could not afford to sit it out. Nothing about that is unusual. It is how most software in most industries gets built. Now the system itself, and this is where the story becomes specific. Knight's orders were handled by a program called SMARS, the Smart Market Access Routing System. Its job was to take a large order from a client, break it into smaller pieces, and route those pieces to wherever they could be filled. A parent order comes in, many child orders go out. As child orders are filled, SMARS keeps a running tally and stops sending more once the parent order is complete. That last part is the important one. The counter is what makes the system safe. Without it, a router would keep sending orders forever. Buried inside SMARS was a function called PowerPeg. PowerPeg was old. It had been written in the late 1990s and used until around 2003, when it was retired. It was a testing tool. Its purpose was to move a stock's price by deliberately buying high and selling low, so that other parts of the system could be tested against price movement. It was never intended for live trading, and it had not been used in 9 years. It had also, crucially, not been deleted. It sat in the codebase, unreachable, dormant, waiting for a flag that nobody was going to set. And in 2005, something happened that turned a dormant function into a loaded weapon. In 2005, Knight's developers moved the counting logic, the part that tracks how much of a parent order has been filled and tells the system to stop, out of the individual routing strategies and into a shared, higher-level part of SMARS. It was a sensible refactor. The counter now lived in one place instead of many. But PowerPeg was not updated to use the new shared counter. It did not need to be, because PowerPeg was dead. Nobody was going to call it. The result was a function that, if it ever ran, would buy and sell without any mechanism to tell it to stop. Not a bug in the sense of a mistake in logic. PowerPeg worked precisely as designed. What had changed was that the thing which used to stop it no longer applied to it, and nobody checked, because checking dead code is not something anyone does. This is worth stating plainly, because it is the heart of the case. The lethal condition was created in 2005 by a routine improvement, and it sat there harmlessly for 7 years. There was no moment at which anyone could have looked at the system and seen a problem, because there was no problem until somebody set a flag. Now the flag, and this is the decision that turned 7 years of dormant risk into 45 minutes of catastrophe. The new retail liquidity program code needed a way to be switched on. Rather than create a new flag, the developers reused an existing one, the flag that had once activated PowerPeg. It was available. It was doing nothing. Reusing it saved a small amount of work. So the code base now contained a single switch with 2 meanings. In the new code, it meant run the RLP logic. In the old forgotten code, it still meant run PowerPeg. The deployment took place over the last week of July 2012. Knight ran SMARS across 8 servers. A technician copied the new code to each of them. 7 servers received it, 1 did not. Nobody noticed. There was no second person reviewing the deployment, no automated verification that all 8 machines were running the same version, and no alert when they were not. The SEC's later order was blunt about this. Knight had no written procedures requiring a review of the deployment and no supervisory process to catch what had happened. So on the morning of the 1st of August, 7 of Knight's 8 routing servers were running new code that would interpret the flag as do RLP. One was running 9-year-old code that would interpret it as run PowerPeg and do not stop. There was one more warning, and it arrived before the market opened. At around 8 o'clock that morning, roughly 90 minutes before the bell, Knight's systems began generating automated email alerts. 60-odd of them went out to a group of employees, referencing errors relating to an order routing component, the code with the reused flag. They flagged that something was wrong with SMARS, on the pre-market orders. The emails were not designed as an alert system. They were system-generated messages of a kind that arrived routinely, addressed to a distribution list, with no requirement that anyone act on them and no escalation path. Nobody investigated before the open. That is not laziness. It is what happens when a genuine warning arrives through a channel that produces mostly noise. Every organization with automated monitoring has this problem. An alert that fires often enough to be ignored is functionally the same as no alert at all. At 9:30, the market opened, and orders started flowing into SMARS. 7 servers did the right thing. The 8th received its share of the orders and called Power Peg. Power Peg did what it was built to do. It bought at the offer and sold at the bid, the opposite of how a market maker makes money. And because its stop counter had been orphaned in 2005, it did not stop. It filled a child order, registered nothing, and sent another, and another. In 45 minutes, that single server processed a little over 200 parent orders into more than 4 million child orders, executing over 390 million shares across 154 stocks. To put that in perspective, Knight accumulated a net long position of around $3.5 billion in 80 stocks, and a net short position of around $3.5 billion in another 74. It was, in under an hour, holding roughly $7 billion of unwanted positions built at deliberately unfavorable prices. The effect on the market was immediately visible from outside. Stocks began moving in ways that made no sense, sharp, sustained, volume-heavy moves with no news behind them. Traders watching the tape could see something was badly wrong within minutes. What they could not tell was what or whose. And here the story turns from an accident into something closer to tragedy, because of what Knight's staff did next. They knew quickly that the problem was in the new code. That was the obvious inference. New deployment, immediate chaos. So they responded in the way that would ordinarily be correct. They rolled back the new code, removing it from the 7 servers where it had been installed, which meant that all 8 servers were now running the old code. All 8 now interpreted the flag as Run Power Peg. For a period, the response made the situation dramatically worse. The one thing that had been limiting the damage was that 7/8 of the order flow was being handled correctly. Removing the new code removed that protection. It is a genuinely cruel detail. The instinct undo the change is right almost every time. Here it was catastrophically wrong, and the reason is that the actual fault was not in the new code at all. It was in the old code that the new code had been masking. It took roughly 45 minutes from the opening bell to stop the trading entirely, which required shutting down the routing system. The arithmetic afterwards was brutal and quick. Knight held around $7 billion of positions it did not want, acquired at prices deliberately worse than the market. It had nothing like the capital to hold them. Over that day and the next, working with Goldman Sachs, it liquidated the book at a realized loss of approximately $440 million. For context, Knight's total pre-tax earnings in 2011 had been in the region of $115 million. 45 minutes had consumed something close to 4 years of profit. The firm's regulatory capital was gone. A broker-dealer that falls below its capital requirement cannot trade, and a market maker that cannot trade has no business. Knight had at most a weekend. What followed was one of the faster rescues in Wall Street history. Over the weekend of the 4th and 5th of August, a consortium, Jefferies, Blackstone, TD Ameritrade, Getco, and others, put together $400 million of convertible preferred stock. It closed on the 6th. The terms were what you would expect from investors negotiating with a firm that had no alternative. The conversion effectively handed the consortium around 73% of the company. Knight's shareholders, who had owned a profitable market maker on Tuesday, owned roughly a quarter of it by Monday. The firm survived in name for a few more months. In December 2012, it agreed to merge with Getco, one of its rescuers. The combined company became KCG Holdings in July 2013, and KCG was itself bought by Virtu Financial in 2017. The Knight Capital Group that opened for business on the 1st of August 2012 does not exist. The SEC's enforcement action, settled in 2013 for $12 million, is worth reading because it is less interested in the accident than in what made the accident possible. It found that Knight did not have adequate controls over the deployment of code to production. It found no requirement for a second person to review a deployment. It found that Knight had no automated system to check that all servers were running the same software version. It found that the firm's capital thresholds, the levels at which trading should be halted automatically, were set so high as to be meaningless, and in some cases were not connected to any automatic action at all. And it found that the email alerts had no defined escalation path. The charge was a violation of the market access rule, adopted in 2010, which requires broker-dealers with direct market access to maintain risk controls. The rule existed. Knight had signed off on compliance with it. The controls, in practice, were not there. Before the aftermath, it is worth asking the obvious question honestly. Could anyone reasonably have caught this? The satisfying answer is that a proper code review would have found it. That answer is mostly wrong, and it is worth understanding why, because it changes what you would actually do about it. Consider the 2005 refactor from the perspective of the developer doing it. The task is to move the fill tracking logic out of the individual routing strategies into a shared component. You identify every strategy in live use. You update each one, you test them. PowerPeg is not in live use. It has not been called in 2 years. It is not on the list because the list is strategies we run. A reviewer looking at that change sees a clean consolidation of duplicated logic across the active code paths. To flag the omission, they would have to ask, is there any code in this system that is currently unreachable, and would it still be correct if it ever became reachable again? That is not a question anyone asks in a code review. It is barely a coherent question, because the answer for dead code is always, it doesn't matter, it's dead. Now consider the 2012 developer choosing which flag to use for the new RLP feature. They need a free flag. They look for one that is not in use. They find one that is genuinely not in use. That is precisely why it is available. Reusing it is the obviously economical choice. And in a code base where flags are a finite resource, it is close to standard practice. Neither of those decisions is careless. Each is defensible on its own, made years apart by people who could not see the other. The failure only exists in the combination, and no individual review encounters the combination. This is the characteristic shape of a systems accident, and it is why the SEC's action focused on controls rather than on finding a culprit. The interesting question is not who erred. Nobody meaningfully did. The question is what stops an undetectable latent condition from reaching a $7 billion position. And the answer is never better reviewing. It is a limit downstream that does not care why the system is misbehaving. The one control that would unambiguously have caught it is the dullest imaginable, an automated check that all 8 servers are running the same build. That is not sophisticated engineering. It is a comparison of version numbers, and it would have flagged the discrepancy days before the launch. there is also a human cost that the case studies tend to skip. Knight employed around 1,400 people. Most of them worked in sales, technology, compliance, and operations, and had no connection whatever to the routing system. They arrived on Wednesday at a profitable, established firm, and by the following Monday they worked for a company 3/4 owned by outside investors, on its way to being absorbed. Thomas Joyce, the chief executive, spent the following days doing television interviews explaining what had happened, in the middle of negotiating for the firm's survival. He described the error, accurately and unusually bluntly, as a large bug, not a hack, not a market event, not something done to them. He kept the firm alive through the weekend and lost it by Christmas anyway. The engineers involved were, by every account, competent professionals doing ordinary work under a regulatory deadline they had not chosen. The individual who missed the 8th server has never been publicly named, which is right, because naming them would suggest the accident was theirs. It was not. It was distributed across 7 years and dozens of reasonable decisions, and the deployment was simply where it surfaced. That distribution is worth sitting with, because it is what makes these events so hard to prevent. There is no moment in this story where somebody could have known enough to act. The information required to see the problem existed only in aggregate, across years, in places nobody had reason to look at together. There is a detail about the aftermath that decided whether Knight lived or died, and it turned on a rule most people have never heard of. When something goes obviously wrong in a market, exchanges can declare trades clearly erroneous and cancel them. If a stock trades at a price wildly away from its recent range because of an evident malfunction, the trades can be unwound and everyone put back where they started. Knight needed that badly. If the 4 million child orders could be voided, the losses largely disappear. They were not. The exchanges reviewed the affected securities and busted trades in only 6 of the 154 stocks. In the other 148, the prices had not moved far enough outside the permitted bands to qualify. Knight's algorithm had been buying at the offer and selling at the bid, aggressive, expensive, and continuous, but not producing the wild dislocations the rule was written to catch. That is a sharp irony. The very ordinariness of the prices, one trade at a time, is what made the damage permanent. A cruder malfunction that had printed a stock at a cent or at $1,000 would have been canceled. Knight's error was too well behaved to qualify for relief. The counterparties on the other side, meanwhile, had done nothing wrong and had made a great deal of money. They had simply been quoted bad prices by a firm that was insistently offering them, and they had accepted. There was no basis on which to ask for it back. It is worth being fair to Knight's people about what happened next, because under extreme pressure they executed well. A $7 billion book of unwanted positions is not something you can simply sell on a Wednesday afternoon. Dump it into the market, and you move prices against yourself, turning a $400 million loss into something considerably larger. Knight went to Goldman Sachs, which agreed to take the entire portfolio off their hands in a single block at a negotiated discount. That was the right call, taken fast. It converted an open-ended risk into a fixed, known loss on the same day. Every hour that book stayed open was an hour in which the number could grow. Then came the capital raise, and 48 hours to do it. Knight's management had to convince a group of sophisticated investors, several of them direct competitors, to put $400 million into a firm whose systems had just malfunctioned catastrophically and publicly. They succeeded over a weekend, and the market opened on Monday with Knight still trading. The terms were punishing. They were also the only terms available, and the alternative was liquidation. Shareholders lost around 3/4 of the company, but the firm's clients, counterparties and employees were not left in a failed broker-dealer's wind down. Given where they started on Wednesday morning, that is a decent outcome competently obtained. The regulatory response is instructive because it tells you what the authorities concluded the real problem was. The SEC did not write a rule about dead code. It could not sensibly have done so. No regulator can specify how firms manage a code base. What it did instead, in 2014, was adopt Regulation Systems Compliance and Integrity, Reg SCI, which applies to exchanges, clearing agencies, and certain other significant market participants. Reg SCI requires covered entities to have written policies for the capacity, integrity, resiliency, and security of their systems, to test business continuity and disaster recovery, to review systems at least annually, and critically, to report systems disruptions and intrusions to the Commission. It made the operation of trading technology an explicit compliance obligation, rather than an internal engineering matter. Knight was not the sole cause. The 2010 flash crash, the botched BAT's initial public offering in March 2012, in which the exchange's own systems failed while listing its own shares, and the Facebook IPO problems at NASDAQ 2 months later had already made the case. Knight, arriving in August, was the fourth major technology failure in the American equity market in 28 months, and the first to destroy a firm. The pattern across those 4 events is the same, and it is not about complexity. It is about the absence of limits. In each case, a system did something unintended at machine speed, and in each case the question afterwards was not, why did it go wrong, but why was there nothing to stop it? The comparison that makes the point sharpest happened almost exactly a year later. On the 20th of August, 2013, Goldman Sachs suffered a strikingly similar accident. A change to an internal system caused it to send a flood of erroneous options orders to American exchanges in the first minutes of trading. Orders priced far from the market, on a large scale, generated automatically. The estimated exposure was in the hundreds of millions. Goldman survived it comfortably for 2 reasons. The options exchanges canceled or adjusted a large share of the trades, because options prices had moved far enough outside their bands to qualify as clearly erroneous. And Goldman's balance sheet could absorb what remained without any question of its solvency. Same category of failure, utterly different outcome. The variable was not engineering quality, it was capital and the accident of which rulebook applied. That is uncomfortable, and it is true. Knight died partly because its error was in equities rather than options, and partly because it was a firm with a few $100 million of capital rather than tens of billions. The distance between an expensive embarrassment and an extinction event was, in this instance, largely circumstantial, which raises the question of what it would have cost to survive it. Consider the control that would have made the biggest difference. An automatic hard stop that halts all trading when the firm's aggregate position exceeds a set threshold. Not a warning, not an email, an immediate cessation, requiring human authorization to resume. Knight's positions passed any sensible threshold within the first few minutes. A hard stop set at, say, $500 million of net exposure would have fired at around minute 3 or 4. The loss would have been perhaps $30 or $40 million. Painful, survivable, a bad quarter rather than the end of the company. The engineering to build that is not difficult. It is a running total, a comparison, and a switch. The reason firms did not have it in 2012 is that a hard stop occasionally fires when it should not, and a market maker that stops trading loses money and annoys clients. The cost of the control is visible and continuous. The cost of not having it is invisible until the one morning it matters. That asymmetry is why these controls tend to arrive only after somebody has demonstrated the need, and why regulation ends up being the mechanism that installs them. Left to a competitive market, the firm that runs without a hard stop has slightly better execution statistics every day except one. Now the general mechanism, because this is the part that outlives the specific firm. Dead code is not neutral. It is a liability that does not appear on any register. The reasoning that leaves it in place is always sound in isolation. Deleting code carries risk. You might remove something that turns out to be used. Deleting code costs time that could go to features. Nobody is rewarded for removing something that is already doing no harm. So it stays and it accumulates in every system of any age. The danger is that dead code does not decay in place. The system around it changes. Interfaces are refactored. Safety mechanisms are relocated. Assumptions are updated everywhere except in the part nobody is looking at. What was once safe becomes unsafe without anybody touching it. And because nobody touched it, nobody reviews it. Then somebody needs a switch and reaches for one that is conveniently free. That is the shape, and it is not confined to trading systems. It appears wherever an old capability is retained past its usefulness in a system that keeps evolving around it. A legacy payment path left enabled, an administrative account nobody has closed, a manual override that was needed during a migration in 2014 and never removed, a decommission process that still has database write permissions. Security professionals know this pattern well and call it attack surface. What Knight demonstrates is that you do not need an attacker. The system will find its own way to invoke the old path, given enough time and one tired deployment. There is a second lesson, and it is arguably the more useful one. Knight's operational failure was not the missed server. Deployments go wrong routinely, everywhere, and always will. The failure was that a single missed server on a single machine could reach a $7 billion position with nothing in between. Every control that would have contained this is boring, cheap, and was already standard practice elsewhere in 2012. Verify that deployed versions match across the fleet. Require a second pair of eyes on a production release. Set an automatic hard stop when the firm's position exceeds a threshold. And route genuine alerts somewhere a human is obliged to look. None of those prevent mistakes. They limit what a mistake can cost. That is the distinction that matters, and it is why the SEC framed its action around controls rather than around the error itself. The last thing worth saying is about speed, because it is what makes this era different. The panic of 1907 unfolded over weeks. The crash of 1929 took days to reach its worst. Even long-term capital management, which nearly took the system with it in 1998, gave regulators most of a month to organize a response. Knight lost more than its entire net worth in 45 minutes, and the mechanism that did it ran without a single human decision after the opening bell. There was no point at which somebody could have thought better of it, because nobody was thinking anything. The judgment had all been made years earlier, by people writing routine code for sensible reasons. That is the condition finance now operates in. The decisions are still human, but they are made in advance, embedded in software, and executed at a speed that leaves no room to reconsider. The gap between a decision and its consequences used to be where prudence lived. For $440 million on one August morning, that gap was 45 minutes long, and nobody was standing in it. The uncomfortable part is that nothing about the underlying condition has been solved. Code bases are older now, not newer. More of the market runs on automated systems than in 2012, and the systems are larger. What has changed is that the limits are better: hard stops, kill switches, version checks, mandatory reporting, because a firm was destroyed demonstrating why they were necessary. That is how this particular kind of safety usually arrives. Not from foresight and not from better engineers, but from somebody going first and not surviving it. Knight Capital's real legacy is not the loss. It is every automatic position limit in every trading system that was installed afterwards by people who read the report.